This is Chuck Harvell. I'm the Chuck in the Markets Up Chuck. And as I said in the blog, today we're going to talk about how do you account for some of the really anomalous things that you can find in the stock market. In every market, whether it's a bull market or a bear market, there's always going to be overvalued, undervalued, or fairly valued stocks. Of course, you're going to find, more undervalued stocks in a bear market than overvalued, and you're going to find more overvalued stocks in a bull market than undervalued, and et cetera. But the real point is valuation matters no matter what kind of market you're in. And I thought it'd be interesting just to point out. I came across a company that was overvalued by any way you would want to measure it. And the real question is, how do you account for this? And I'm going to compare it to another company in a similar industry that is actually fairly valued. So let me go ahead and get on with it. The company is Coinstar, and this little company turns coins to cash. If you look on their website, this is actually a very interesting little company. They have these little, vending machines or kiosks that you can take the cash that you have laying around your house and turn it either into cash or get credit on your credit cards. And they're putting these machines through retailers all throughout the country, grocery stores, retail stores, of all kinds. And the bottom line is that people are all excited about that because it's something new. They estimate there's like the average person has around $90 worth of coins, and during a recession, people are motivated to cash in those coins. So there's a lot of hype behind this company, but how much of that hype is actually fact relative to the value of the stock? Using our fundamental analyzer research tool, let's examine that. Over the last 7 years, their earnings have actually dropped. They've gone from 91 cents down to current 72 cents. You see, they are profitable and they have made money, and they did have a pretty good year, or they're estimated to have a pretty good year in 2009. And you can see there's a lot of volatility in their stock price. But the company is currently trading at 45 times earnings. And if they have 46% debt on the balance sheet, and they're only an $860 million company. Their track record is, okay. Over the last 7 years, because of the price volatility, $100,000 would have grown into $125. That's a 3.6% rate of return. But they are forecast to grow at 19% a year going forward. And as I mentioned, they have 46% debt. So that's a lot of debt, for a company of this size. But if you look at it from a valuation, if they were to trade at their normal price at a more justified price earnings ratio, let's say of even 19 times earnings, then the rate of return on this company would be relatively low, although high by some standards at around 10% relative to the amount of risk you would take to buy it. But 45 times earnings is a very high price to pay, and what you're really buying here, in my view, would be hype. In other words, for every dollar's worth of earnings you buy here, you have to pay $45 to buy it. Now let's contrast this to another small cap company that has a pretty good business in a recession also. It's Easy Corp. It has pawn shops basically scattered. There's over 305 in the U.S. and 38 in Mexico. And as you can see, their net income increased over 41% in the March quarter. So let's see how this small cap company and its growth rate stacks up to Coinstar. If you look at the last 7 years, Easy Corp's earnings have grown from 15 cents to a $1.51 estimate. That's over a 58% growth rate. The company has a similar market cap, about 590, we'll call it $600 million. No debt on the balance sheet, so for it's a smaller, riskier company, just like Coinstar is. But look at this: the company's only trading at 9 times earnings. So in other words, you only have to pay $9 to buy $1 worth of this company's earnings that are growing at 18%, which is the equivalent, in my view, to the 19% forecast for Coinstar. The numbers really are the same. But why would you pay $45 to buy $1 worth of Coinstar's earnings, growing at the same rate that you'd only have to pay $9 to buy Easy Corp? Another way to look at that is you could buy $4 worth of earnings of Easy Corp for the same price that you would have to pay to buy Coinstar today. And if you look at the difference in track record, $100,000 in Easy Corp over the last 7 years would have grown to $1.1 million, averaging over a 46% rate of return. The track record differential here is unbelievable, but yet Easy Corp is on sale. It's actually a company that's trading at a significant discount to a normal PE of around 14 that it's traded at, and certainly a significant discount to its growth rate, even its current forecast growth rate of 18%. The potential rate of return if this company achieves this growth rate and just hits this target would be over 30% a year compounded. So, the real question is, how do you account for that? And I guess the real point is investors need to be paying attention to the fundamentals when they're looking at companies and not just buy the hype and hysteria. As I say later in the ending part of this blog, you don't want to be the greater fool, and that's foolishly paying more for a company than it's worth on the basis that a fool greater than you will come along. Valuation is a critical component of the investment investment process. And Coinstar might actually be an excellent investment going forward as long as you could buy it at something below 18 times earnings. But at 45 times earnings, I believe the risk is high and the returns are low. Easy Corp, on the other hand, with no debt on the balance sheet and assuming the same type of growth rate and only trading for less than 10 times earnings makes a lot more sense to me. I hope this was of value to you. And this is Chuck Carnival saying goodbye. Thanks for listening, and I'll talk to you